Hi everyone, I'm Jim Wink with Summit Financial Consulting, and I wanted to do a quick update with some interesting information I came across in the auto and housing markets that I think you'll find noteworthy. This may be especially important if you're in the market for a new home or a new car. I'll also go over a potential red flag we're seeing right now in the stock market. So let's get started. In the broader car market, used car and truck prices are seeing a significant decline. Prices are down almost 18% since their peak in 2021. So if you remember when prices were going through the roof just a couple years ago, good news, that trend has reversed, marking the largest decline we've seen in about 15 years. Prices have been coming down for 22 months now. In June, average wholesale prices decreased by 8.9% year over year to about $18,000 per car. Now, electronic vehicle makers have been hit especially hard, with some prices falling over 40% since last year. I don't want to say the bubble in the car market has burst just yet, but there definitely is a leak right now. And not to pick on Ford, but I think this is a pretty good example. Ford is expected to lose $5 billion on its EV business this year alone. Their sales have plummeted 37% last quarter, and this is translated to a $44,000 loss on every EV that they produce. So if you've been waiting to jump into the EV market or jump on the train, now might be a good time to look into it. The company recently experienced its worst daily stock performance since '08, losing 18% in just one day. Now, these setbacks indicate that Ford's heavy bets on EVs have not paid off as anticipated and should affect their decision making moving forward. Now, switching to the housing market, we've seen some noticeable trends as well. New home inventory in the southern U.S. has reached new highs. Inventory has surpassed 2007 levels, with new homes now selling for less than existing homes for the first time since 2005. When older homes fetch higher prices than new ones, it signals underlying issues in the market. 1 in 5 U.S. homes for sale had a price cut in June, the highest level out of any June on record, and mortgage demand is at the lowest it's been in nearly 30 years. The supply of new homes is surging while demand plummets. This imbalance suggests that further price cuts could be on their way. Now, these trends in the car and housing markets could have broader implications for the economy and the stock market. The decline in car prices and the struggles of major automakers like Ford can lead to decreased consumer confidence in spending. Also, the oversupply of new homes and falling prices could signal a cooling housing market, potentially leading to reduced construction activity and job losses in related industries. There's also a concern about our national debt and interest rates. In June, 76% of all personal income tax went to servicing the $34 trillion and growing national debt. High interest rates have been exacerbating this issue, so there's a pressing need for rates to come down to alleviate some of this burden. Finally, I want to mention what U.S. executives are doing with their stocks. We like to stay updated on what the big money institutions are doing with their investments. Typically, before big downturns, we tend to see the larger investors get out of the way and leave the little guys carrying the bag, so to speak. We found corporate executives are selling stocks at the fastest pace in at least 10 years. The percentage of publicly traded firms seeing net purchases from their officers and directors has dropped to 15% from an average of about 26%. Now, after a historic run higher in the stock market, corporate executives are taking profits on their own stocks, possibly indicating their concerns about future market performance. So in summary, the current trends in the car and housing markets combined with broader economic challenges suggest a period of volatility ahead. Right now could be an especially important time to be cautious as the Federal Reserve begins cutting interest rates instead of increasing interest rates like they've been doing for a couple years now. As always, staying informed and making well-considered financial decisions is crucial. So thanks for watching today, and I hope you found these insights valuable. Once again, I'm Jim Wink. Stay tuned for more updates and insights. Until next time, take care and stay financially savvy. Thanks a lot.
Summit Financial,
working with people you trust.